is that the portfolio has performed incredibly well, largely due to a couple of very fortunate share picks, one in particular, and then on the other hand, by avoiding the big losers. We haven't done well on Apple, but outside of that, everything else has been pretty strong. And then the Rand. So the depreciation of the Rand was our big bet right from the beginning, and the Rand indeed has fallen. It's the share price of a country, the exchange rate, and if economic policies of a country are out of kilter and out of step with other parts of the world, then you will find that the exchange rate unfortunately does reflect that, and that's exactly what we're seeing with the Rand. In the past month, it's been an interesting development over the portfolio. I'll just take you through it very quickly. No change at the top there with Vanguard. It's pretty much where it was a month ago. But with the depreciation of the Rand, which has gone from 14.26 when we spoke on the 28th of April, to 15.79 today, 24th of May. That depreciation has suddenly turned Vanguard into a big winner. So since we invested in the S&P 500 index, and if we just go back a little bit and understand the structure of our portfolio, we wanted to put about a third of the funding, and we started off with $200,000 US. About a third of that we wanted to put into the S&P 500 index. Another third split between two big shares. We selected Google and Berkshire Hathaway, and then 5 other shares which we would use as share picks. And the idea being that when we found another share pick to add to the portfolio, we would reduce the holding that we have in the S&P 500 index. So quite simple approach here. You put a third of the money in the market, generally, a third of it into 2 big stocks, and then the other third for share picks. And we started off with a third of the portfolio in the Vanguard S&P 500 index. Last month, we swapped out around 8% of that. It was at 30% generally, to buy Barclays shares. And the Barclays shares are the first non-US stock to hold in the portfolio. It's been a spectacular success, not because Barclays has done a whole lot. As you can see there, it's up by 1% in pound terms, but because the Rand has fallen against the pound. So the Rand is down from 14.26 to the US dollar to 15.79. In pound terms, it would cost you 20 Rand 88 cents for a single pound a month ago. It's now 22 Rand 87. So a 2 Rand depreciation there has had an immediate impact on our investment into Barclays PLC. But when you have a look at the portfolio generally, it'll give you an understanding of how we're positioned. We've done well with Alphabet. That's grown by 32% in US dollar terms. Apple has been the big disappointment. That's down 23%. In fact, Apple, we liked it so much, we doubled up our bet. We bought it as one of the share picks, where we put a presumed 8% in each. And then we liked it so much, we even bought another one, another 8%, to take it to a target holding of 16%. But as you can see, because the share price is down so much, it's only 11% of the portfolio. On the other hand, we're in good company because Warren Buffett, his Berkshire Hathaway, has made only its second technology investments, and that's into Apple. Another stock that Berkshire Hathaway does hold is IBM. You can see that's also a laggard, although the good news for us is that we bought into that at a Rand level that is a lot stronger than where we are today. And even with Apple, although it's down 23% in dollar terms, it's only down 1% in Rand terms. IBM, because the Rand has depreciated, in fact been a winning bet for us. So it's quite incredible the impact that the currency has had. As you can see, though, the star performer in the portfolio is Amazon.com. It's gone from an initial 8% of the portfolio to 16% now, and that is because the share price has risen 112%, more than doubled, since we bought into the stock. Amazon, without question, our favorite share. And when you do operate from a country where Amazon is getting quite a lot of traction, which is here in the UK, you can see why the investment community is grabbing onto Amazon. We ordered something through Amazon Prime last week. It arrived the same day at our house in the front door. The guy knocked on the door and said, "Here is your product, Mr. Hogg." Quite extraordinary, the service that is being delivered. And if you go back and read through the transcript for the Berkshire Hathaway AGM, Warren Buffett referred to Amazon numerous occasions, and he actually made the point that when you have got millions, or in this case tens of millions, of satisfied customers to whom you're delivering your goods and services instantaneously, i.e. services and online, or your goods very rapidly, in this case the same day, then you do have a irresistible business model. He only said something similar years ago when he referred to Google, and that caused a run on Google shares from the Berkshire faithful. Well, the Amazon share price, a combination of Buffett's endorsement and the quarterly results that came out that were very pleasing, has seen that share gain $100 in the past month. As you can see, the price is now just under $700. We bought in at $327, but it's come from $600 a month ago. So that's helped the portfolio overall to show the incredible return, annualized, of 36%. You can get that in a few months, but when you've been going for 17 months, it's really very, very pleasing. Most important reason for this has been the Rand. As you can see, the Rand has depreciated since we started the portfolio on the 5th of December from 11 Rand 27 to its current 15 Rand 79. That's an annualized drop of 28%. But the other part that is kicked into the portfolio, we've managed to add almost another 10 percentage points annualized to the return of this portfolio through some fairly fortunate stock picking. And this table that you're looking at now will give you an illustration of that. As you can see, the Vanguard S&P 500, which is now down to about 19% of the portfolio in Rand terms, that has grown by 40% overall. But actually in the last year is done nothing. The S&P 500 has not moved at all. In fact, it hasn't moved since the 5th of December. The purchase price, 5th of December 2014, as you can see, there was $188. It's now still $188. Alphabet, on the other hand, has been a good return. It's gone from a purchase price of $534 to $704. Apple, the other way around, our purchase price there is nearly $125 a share. It's at the moment at 96. Berkshire Hathaway, a little bit below where we bought in dollar terms, 149 to 141. But look at Amazon, $327, call it $328 a share to nearly $700. Novo Nordisk, another good dividend payer, as is Apple, up from $46 to $53. IBM a little bit lower, and then Barclays, which we bought last month. And this shows you how the impact of the Rand in the last month has affected this portfolio. We bought in there at a price of £1.74 a share. The share price is £1.76. So we've regained the costs that were incurred in the transaction. But the Rand depreciation against the pound has given us an 11% gain in that share. And really, when you have a look at the portfolio overall, our intention was to get to a position where we could, if you like, take a bet against the Rand. We believe the Rand would weaken, but on the other hand, we would also try and find share selections in the global market which would give us an uplift on the Rand depreciation. So the Rand down 28% has fulfilled that big bet that we had, but the annualized return of the portfolio at 36% shows you that our stock selections have also been very pleasing. Remember that this is interactive, so if you have any questions, please just fill in the box there. It's pretty easy to pose a question. Now, once you've done that, Stuart will interrupt me, and we'll refer to your question and answer it immediately. So please go ahead and ask your questions as soon as something comes to mind. Moving on to the prices at opening until today, this gives you a good understanding of how the portfolio has performed in Rand terms. The Rand dollar down 40%, incredible. 20% a year is what we're losing on the currency at the moment. The big winner being Amazon.com, nearly doubling. In fact, up 198% means it's nearly trebled. And the annualized growth there of 140%. So in Rand terms, it's been an enormous performer, but even in US dollar terms, a very good return. Alphabet, 85% in Rand terms, Novo Nordisk. In fact, the better way to look at this is having a look at the table we now have on your screen, which shows you very clearly that Amazon, Alphabet, and Novo have been our big winners. Vanguard pretty much break even, and then Berkshire and IBM underperformers in US dollar terms, or underperforming the Rand US dollar depreciation over there. You can see them there. And Barclays has only been in the portfolio for a month, so it's already showing a good contribution, but again, that's all currency related. And Apple being the disappointment, but we've got some fairly good news on that coming up. Moving on to this month, we do report 2 more dividends. A good dividend payer is IBM. There was another $1.40 dividend that was declared in, and rather paid in May. That's added another $140 to our cash holdings. And then going down, you'll see Apple also lifted its dividend from 52 cents to 57 cents. And it's quite interesting to notice that those companies declare and pay dividends every quarter. So Apple's gone 52, 52, 52 cents, and in the last quarter, although the market didn't like the results, they paid a 57 cents dividend, which is an uplift on the previous number. Similarly with IBM, a 10 cents higher dividend declared in its most recent quarter. Let's get into the nuts and bolts of the portfolio. Vanguard, remember this is our exchange traded fund. The reason we went with the Vanguard VOO, as it's called, listed on the New York Stock Exchange, is because the costs here are very, very low. And as you can see, identical performance between Vanguard and the S&P 500. When we bought into Vanguard on the 5th of December 2014, until today, there's been no move. In the past 12 months, though, and we like to show you our graphs on the last 12 months, it has tracked the overall index down by 2.7%. So if we had put all of our money into Vanguard, in other words, into the market in the United States, instead of having the 28% annualized gain that we've been showing because of the Rand depreciation, we'd be down to about 26. So it does show you the uplift that has been created by having a more diversified portfolio. Berkshire Hathaway, my favorite share, well, my favorite company, can't say my favorite share, but my favorite company, Warren Buffett, has been running it for 51 years. The annual general meeting, once again, was extremely well attended. The share price of Berkshire Hathaway, though, is done a little bit better than the overall market in the past year, which is good news. But since we've had it in the portfolio, it's done a little bit worse. But this is what we do anticipate from Berkshire, that it will outperform the S&P over an extended period of time. The big news to come out of Berkshire in the past month was the investment in Apple. This wasn't done by Warren Buffett himself. It was done by one of his portfolio managers. They haven't said which of Todd Coombs or Ted Weschler has made the investment, but $1 billion in the context of a $120 billion share portfolio that Berkshire has is not that big, but $1 billion is still a lot of money in anyone's terms, and it caused quite a lot of excitement. It did, in fact, lift up the Apple share price by 3% and got analysts making all kinds of assessments. Has Apple gone X-growth? Has it become more of a utility company? Why is Berkshire buying it? The reality is that Apple is just cheap. It's really, really cheap. It's sitting on masses of cash. In fact, $216 billion cash on that balance sheet now, and it's only valued is Apple at about $600 billion. So you've got about a third of the valuation is actually in cash. So it tells you quite how underrated or undervalued the stock is, and this was enough to attract Berkshire Hathaway's attention. But let's put it into context. The biggest holding, the biggest single holding that Berkshire has in a listed company. Remember, it just did the Precision Cast Parts investment for $32 billion. So that's the, if you like, the biggest wholly owned subsidiary. But of the listed companies, the deal that it's done with 3G, the Brazilian venture capital business, on Kraft Heinz is worth to Berkshire at the moment $25 billion. It's in its own portfolio where it doesn't have a substantial holding, over 25%. That is, the biggest share there is Wells Fargo, which is around 10% of the Wells Fargo stock held by Berkshire. That's valued at $23 billion. Coca-Cola, $18.5 billion. IBM, $12 billion, and Amex, American Express, around $9 billion. So in that context, the Apple investment is relatively small, but on the basis that it is a technology investment, quite significant. Warren Buffett called Google the perfect business model, and now called Alphabet because it's a holding company. In fact, Larry Page and Sergey Brin restructured their business to make it look more like the structure of Berkshire Hathaway. And here we have the company performing incredibly well. Again, in the past year, Alphabet is outperforming, or has outperformed, the NASDAQ by 37%, as you can see on your screen there. So it's a nice place to have our investments. I'm not sure what's happening with the questions, Stuart, but I don't see any that have been posed yet.
No, like there's no questions through. I'm hoping it's not the chill in the Joburg air this side, or the wetness in Cape Town, but there are not
technology, because we've got enough people who are actually on the seminar to at least be posing questions. Now, I don't know if you guys want to fiddle around and just see maybe the tech isn't working as well as it should be. Anyway, we are standing by for your questions, and I hope at least somebody can try it. Maybe you can put a little test on, Stuart, and just see if the question is working. I've got a suspicion by this stage we normally have quite a few questions, so there could be something in the tech.
Is Alphabet too expensive to buy now, from Ian Hall?
Ian, thanks for that. I'm still not seeing the question on my side, but that doesn't matter. It's important that you see it. No, it's not too expensive. Ian, what I would do right now, if you're going to replicate this portfolio, is instead of buying it at in one fell swoop, by doing that, you start taking the risk on the rand and the risk on timing. So to eliminate the timing risk and to eliminate the rand risk, stagger your purchases over 3 months. So let's just say you have R1 million, which you can put into the web trader portfolio, no questions asked. I'm not sure if you're really aware of this, but up to R1 million, the South African government says you can take that offshore. It's called a discretionary exchange control allowance. It's not, you don't have to ask any questions of anyone. You don't even need a tax clearance. So you can put R1 million into your web trader account, and if you, for argument's sake, had that amount of money that you decided to invest, I would stagger the purchases, replicate the portfolio as we have it, but stagger the purchases over 3 months. So the first month, today, you can put 333,000 Rand, and then allocate that accordingly. Then in a month's time, similarly, the next third, and in the following month's time, the next third. Because, Ian, we are talking about a dual impact here, not just the share price of Alphabet, but also the rand. And the rand, as we've seen in the last month, as volatile as it was, going from 14.26 to 15.79, it has a far bigger impact sometimes than the shares that you're investing in. So stagger it over 3 months, buy the whole portfolio. Even though Amazon, for instance, has nearly trebled in price since we bought it, it doesn't mean that it's out of kilter. I'm still a big fan of Amazon. And remember, this portfolio is based on buying forever, holding forever. The only stocks we would sell is where we see a fundamental change in the underlying value of that company, or where we want to add a new, more attractive company into the portfolio. We've got a lot of runway still to do there, because we can still sell quite a big slug of the exchange traded fund if we find, or as we find, more appealing places to put it into individual stocks. So we would be talking about probably buying another 3 share picks before we have to look at our portfolio and then start offloading or anything like that, or swapping around. So the point being, stagger your purchases over 3 months.
Just a follow-up from Ian. Sorry, he says he's already got the money offshore, so does he still follow the 3-month process or buy it in one whack? Because he takes out the rand issue, he says.
Yes, I still believe that you should buy it over 3 months, because that takes out the concern of, in investing, what you're trying to do is reduce the risks all the time. And the risk that you have is of buying at the wrong time. And by staggering it over 3 months, you take that risk out. Or you can't eliminate it completely, but you substantially reduce the risk of maybe buying on a day when the share price is at some kind of a peak. We don't know. Only the good Lord knows the future. But we try in investing to reduce the volatility as much as possible. So it's almost doubly sure that you should be doing it if you have, if you're making the investment in South African rands. But even if you are, if rands aren't part of the equation, you still need to be cognizant of the fact that share prices themselves can also be fairly volatile. When you look at the Alphabet share price here on this graph, though, it's really traded in a very narrow band since early November last year until May this year. So the last 6 months, it's been in a band. So your risk of buying it now, if you do decide to go for a one-off kind of hit, is a lot lower than it would be maybe with other stocks. But I would still recommend you stagger it over 3 months. All right, let's move on to our next stock, and this is our, of course, favorite company, favorite share, rather than favorite company, but it is a fantastic company as well. When you get exposed to the service that Amazon offers, when you listen to the way that Warren Buffett enthuses about Jeff Bezos, and I'm busy reading a book, in fact, about Bezos at the moment, where you get encouraged again to go and have a look at his annual reports. He writes all of his annual letters to shareholders in the same way as Buffett writes his. It is just an incredible business, this, and one that, Buffett can't find any way to beat the business model, so who are we to argue with that? It's also been a wonderful performer for us. It did come down quite sharply in January when we had the sell-off this year, but has recovered and then some, had a particularly good month for us, jumping by $100 a share. Just to put that in context, we only bought them for $300 a share, or just over $300 a share. So from our purchase price, the gain was about 30% in the past month. And Amazon is, well, it's always got issues to consider. The latest issue that's being raised there, and you can see a little bit of a drop in the share price in the last few days, is that the European Union claims it's been paying too little tax. They're looking at a 400 million exposure potentially, and this is being motivated by Margrethe Vestager, who's the EU's competition commissioner. But Vestager has got quite a few companies like Amazon on her radar. She's been fighting with Apple due to its Irish domicile for quite some time. She's also trying to find other companies like McDonald's that, in her estimation, are paying too little tax. As far as Amazon's concerned, they are registered in Luxembourg. They have a very good tax deal with Luxembourg, but it isn't just used as a shell. There are more than 1,000 Amazon employees who work in Luxembourg. So they believe they've got a very good case, and even so, in the context of a $320 billion US company, a 400 million fine is not really anything to get terribly concerned about. So that, but that was the story from Amazon. There was also a sale by Jeff Bezos of about of 1 million shares. He banked $671 million as a consequence, but no need to get worried there because he still owns 17.5% of the company. So 671 million compared with the billions in value that he's invested in. I guess he just wanted to find somewhere else to have a little bit of fun. Bezos is very good at that. As you might be aware, he did buy the Washington Post a few years ago for $250 million. And I guess if you got it, well, why not flaunt it? On to IBM. Here's a stock that has been a disappointment in a share perspective, but still one that we love the performance of the business. You've got to understand the IBM story, which is a company that has been around for more than a century. It's got relationships with every member of the S&P 500, the top 500 biggest companies in the United States. This opens the door for its salesmen to go and sell new products. Only, what was it, 5 years ago, it put together a 5-year plan. It seemed at that time as though the business had become so stable that it was just going to be generating almost utility-like, like electricity supplier. But IBM then was hit very hard by the cloud. That, incidentally, is one of the major reasons, still not fully discovered, but one of the major reasons why Amazon is doing so well. They've got they had a jump on everybody else in cloud computing, or allowing you to put your data and hardware, dispense with your hardware and put your information into the cloud. IBM understood this and has adjusted its business accordingly, but not quickly enough for Wall Street. It's about 30% of its business now is in new type operations. And it's been a massive job to refocus this oil tanker, but it's moving in the right directions. And in Gilly Rometty, they have one of the best CEOs in the world. Warren Buffett has been buying these shares since 2011. He has built up a shareholding of around, well, $12 billion US, and he's about $2 billion US below the price that he paid for them. He was asked at the AGM if he's still happy with IBM, and he said he certainly was. And at these levels, it's not surprising to see him continuing to buy every time we get a filing from Berkshire Hathaway. It's still great value. Novo Nordisk is one of our sleepers. It's strong in the diabetes field, where it owns about a third, somewhere between a third and a half, depending on which product you talk about, of the insulin market. Anybody who is diabetic will tell you that there is a massive barrier to entry for new people coming into selling of insulin. And Novo's advantage is that it is moving more aggressively into the United States with a couple of new products. That's, of course, the biggest market in the world. It's a Danish company. It pays good dividends, performs better than the market most of the time. It hasn't done so in the past year, and that makes it a nice entry point at the current pricing levels. Apple, it's been our disappointing performer, but every decline in share price is an opportunity for someone else. Since the Berkshire Hathaway investment of $1 billion, the share price has lifted, as you can see very clearly on our graph there. It was down by 30% in the past year at one point. It's now down 25%, so still quite in an underperformance against the its NASDAQ, the benchmark that it performs against. So it's a 30% underperformance against NASDAQ in the past year, but a company that's got a third of its market cap in cash money. And then it has the iPhone, which, as you know, is ubiquitous. But what I like about this company, and it hasn't really been clicked around the world, is that they invest hugely in research and development. And the research and development as a percentage of the revenues has been growing. Now, this tells you there's something happening at Apple. It's a very secretive business. It always has been, since the days that Steve Jobs believed it was nobody else's business what his business was, or to tell them what his business was. And as a consequence of that, they're busy with something. They put a lot of money into it. It's not the Apple Watch. We know that that's been successful, but hasn't really shot the lights out. It could be virtual reality, which is a developing new field, but more likely it's something to do with driverless cars, where Google has been the most public company to make the running, and Apple has shown there's been enough feedback, kind of secretive stuff, to show that Apple's also getting big in that field. They've been investing heavily. There is a there's something around the corner from Apple that is going to excite all of us. You can just feel it. And it's a stock that, on any kind of valuation, you've got to believe that this is the one you should be adding to your portfolio at these levels. You won't be sorry. So let's just close off, though, the portfolio for today. The Rand dollar, as you can see, has depreciated rather, from 11.27 to 15.79. That's given us a annualized return. If we'd just taken the $200,000 that we started with and put it straight into US dollars and done nothing else, an annualized return there of 28%. Incredible. As you can see, the Vanguard S&P 500 index, since the beginning of the portfolio in December 2014, has done nothing. And in the past year, its annualized return has been, in US dollar terms, nothing. But because of the Rand's depreciation, you've got a 28% uplift there. So it's quite easy to understand this portfolio. Amazon, Alphabet, and Novo Nordisk being the outperformers. Vanguard tracking the Rand generally. And then we have Berkshire Hathaway, a slight underperformer. IBM, a bit disappointing. And Apple, even though it's only down 1% in Rand terms, has been the most disappointing. But that would also tell you that there's wonderful value to be had there. Barclays has only been in the portfolio for 1 month, so that 127% annualized is obviously unlikely to be, well, let's hope, but it's unlikely to be something that we would anticipate in a year. Although Barclays did get some good news this week. If you recall, one of the reasons we were that keen on the business is that the sale of its South African asset of ABSA, which makes up 85% of Barclays Africa, is going to translate into a release of considerable capital within Barclays PLC, and it will also bring into Barclays PLC a big chunk of additional capital. Now, this is all part of the restructuring. It's taken some fairly bold decisions from the new chairman, McFarland, and his new chief executive, Jeff Slaney, to go ahead with this strategy. Barclays, however, at its core is one of the UK's big four retail banks. Between the four of them, Royal Bank of Scotland, Lloyds, HSBC, and Barclays, they have 80% of the UK's retail market. And that's a fantastic place to be. Very, very low turnover. The churn rate is about 1.5% a year. So once you start with a retail bank in the UK, it seems as though you stay with it. And that is a wonderful franchise which is not appreciated in the Barclays share price. Still trades at about 1.3 times book. A more normal level of trading would be double that. So there is lots of upside potential for Barclays. They're cleaning house. We expect that despite some more obstacles that they still have to overcome, that this is one that has been sold down too far. So if you want to ask for value, the great value bets in this portfolio would be Barclays and Apple. IBM also good value. And of course, the longer term performers that we're very happy to stay with are Amazon, Alphabet, and Novo Nordisk, with Berkshire Hathaway and Vanguard being your cause, if you like.
Alec, while you're on Barclays, sorry to bother, Alan D wants to know your view on Brexit.
Alan, I haven't done enough research into it yet. I'm doing that. I'm doing a lot of analysis now. As things, the bit that I know is it's rather bizarre that from an economic perspective that it's even being considered. All of the information suggests that the UK economically would be poorly served by leaving the European Union. But it's strange times that we're living in. If we have a look at the way the political world around the world is transforming, the political governance does need a shake-up. It's not just in South Africa, where the voters are unhappy at the way that the system is structured, where you vote for a guy once every 5 years, and as long as he, as you believe his lies aren't bigger than the next one's lies, you vote for him again and then just give him absolute power, which is a a really strange way of running, or a very strange way for democracy to work. So there's been a big kickback, and I would like to believe that common sense will prevail in the UK. But on the other hand, the possibility is the swing towards the unusual, towards the eccentrics in the political arena, says that a Brexit is not out of the question. So if it were to happen, it would affect the US economy, the UK economy. It would affect the UK currency. The pound would definitely come under pressure. It would affect asset prices like housing prices. There's an estimate that I saw the other day to say that they would fall by 18%. I don't know how they get so specific with these things, but it is it would definitely have an impact on UK housing, which on the other hand has been expanding so rapidly over the last few years that the locals are uncomfortable with the fact that the young people find it impossible to actually get into the housing market, to own new homes. So there are many different variables, but generally from an economic perspective, it isn't a good thing. It could be perceived as a good thing from a security perspective, but from an economic perspective, definitely not.
Alec, on the Rand, I think I can answer this for you, but they want to know your view on where it might go, Aresta and Philip, on the Rand dollar price.
Yeah, our view is on the Rand is consistent. The exchange rate of a country is it's like the share price of a country. And the share price of a company is determined by the capital allocation of those running a company. And similarly, the share price of a country is determined by the capital allocation of those running the country. When you look at it in those terms, in pure economic terms, you have to understand, or you have to come to the conclusion that the capital allocation by those running South Africa has been poor and unlikely to change much. The socialist type policies where social grants are now built into the system, and a very big part of the system does not make for wealth creation. We've seen this many times around the world in the past, where socialist ideas, although incredibly well intended, just don't work. Human beings need an incentive. Far better would be to allocate the capital more sensibly to where the country has advantages. Think of it, if you are confused, like a company. If a company is an IBM could easily have sat back and just kept pouring money into the areas of its business which were getting eroded by technological developments and by changes. Instead of doing that, it stopped and it started allocating capital into new areas like artificial intelligence, like its Watson supercomputer, into the cloud itself, which was the biggest threat to IBM, and it saw this and then started investing in cloud capacity. And as a consequence, IBM is positioning itself well for the future. South Africa's advantages, the two most obvious ones, are being terribly neglected, the one being tourism, where political imperatives are continuously affecting the tourism industry. We had the insanity by Minister Gigaba on the visa regulations. And, if you're sitting in a country somewhere else in the world, of course you'd like to come to South Africa. It's a beautiful place. But if you have to go through too many hoops, you might decide to rather go to Croatia or Australia or Vietnam or any of their other more than 150 destinations that are available. And this latest move by the Minister of Sport to summarily decide to not allow any international events by the major sports bodies that could host those global events is extremely short-sighted and extremely costly. So tourism is not an area where the capital is being sensibly allocated. And the other one is on fracking. We had a piece this morning on Biznews showing how Britain is going to start once again fracking for the first time in the last 5 years. What happened 5 years ago? One of the frackers hit a fault and there were earth tremors. And as a consequence, there was, I want to call it panic, but this is a very stable society in the UK, and people were unhappy about it. There was a big investigation, a moratorium on fracking, and that is now being lifted by a company called Third Energy, which is going to be fracking a well in Yorkshire. Now, why this is relevant is that the UK has got shale gas roughly 1/15 the size of South Africa's. It's got an economy 8.5 times the size of South Africa's. So if you look at it from that perspective, the incentive for South Africa to utilize its shale gas reserves is 120 times higher than the incentive for the British to do it. The British are just champing at the bit to get ahead with it. Their shale gas will take care of their requirements for the next 9 years. South Africa's will take care of its requirements for energy, not just gas, but everything else, for hundreds of years. And yet the treacle of bureaucracy stops it. If you were a capital allocator, you'd be throwing money at the exploitation of shale gas to try and bring that to account and, of course, give you the economic impact. The failure or the absence of that says these guys don't, the guys running the show do not allocate capital efficiently, despite sitting on some sizable assets. As a consequence of that, the share price or the exchange rate is unlikely to perform the way it should, and as a consequence of that, we would rather not be invested in that exchange rate.
Two questions quickly before you close off, Alec. Clive wants to know if you use technical indicators to buy, and Aresta wants to know if Vanguard pays a dividend or pays dividends.
Well, we'll start with the second one first. Aresta, yes, Vanguard does pay a dividend. I'm just going to go back to where the dividends, where Vanguard is on here. Every quarter, you'll see that there's a decline in the share price at a period in time, and that's usually due to the dividend payment. For some reason, we didn't have our dividends table on here. It pays a dividend 4 times a year. It's not very big, but it is a small contribution. On the other aspect, sorry, Stuart, just that technical analysis story. I have applied my mind to technical analysis. In fact, I found a book from an old friend, Gene Moon, who taught me about technical analysis when, in the days before computers, really aging myself now, we used to have a thing called Trendline, and every month, I think it was, or every couple of weeks, Trendline would print out on graph paper the share price graphs of the stocks on the JSE. And you could then, by using the technical tools, come to some pretty good conclusions on which way the shares were likely to move in the short term. My problem with technical analysis is that it can become, one becomes a little obsessive with it, and the world doesn't work according to these cycles every time. A far better way to invest is to have a look at, is to buy $1 for less than $1. To buy a dollar bill for less than $1. Try and get a dollar bill for 80 cents. Rather than saying, well, that could be worth 150 at the moment, the technicals say it's going to 170. Technicals, we have black swan events, we have all kinds of other events that come along that can throw you out very badly on technical analysis. And when you get too invested in it as the primary tool, it can burn you. And I've seen this happen in my career many times to people who had impeccable reputations for a period, only to be caught out at the last hurdle or at a hurdle. So there's nothing wrong with looking at technical analysis or looking at long-term share price graphs to give you a sense of whether that share price is excessively priced at the moment, or if Mr. Market has got terribly excited or terribly depressed. But I would not base a decision on buying or selling a share on technical analysis, certainly not technical analysis alone. It would be you buy a share after you do your research, after you establish the intrinsic value, and you see that that share is trading at a discount of 20% or more, if you're lucky, to the intrinsic value, which is the case, for instance, with IBM and Apple right now. On the other hand, when you see that the share is above its intrinsic value or trading above its intrinsic value, as much as you like the company, it's not the time to buy it. You wait until the everything's in your favor. That's what I like to judge the purchasing of stock on, not on where the share price has gone. But some people have done pretty well out of technical analysis, and I don't want to have a flood of them showing me how clever they've been. It's just the way that I like to recommend that one invests for the long term. And remember, that's the other thing. Technical analysis will give you all kinds of signals on buying and selling shares. That brings in new costs to the equation. And for investors in the long term, that's the one thing you've got to try and get out of the system is costs. So if you buy today at a good price and you hold that share forever, or until the management of that company disappoint you through acting fraudulent or fraudulently, as they did with Warren Buffett with Tesco, or if you find that you've got a better opportunity comes along that you'd like to switch into, that's the time that you sell the shares. But generally, when you buy a stock, the underlying company should be so attractive to you, and the price that you're buying in at so appealing that you would hold it forever.
I think that's it from my side, Alec.
Wonderful, Stuart. Thank you. And thanks to everybody for joining us today. It's been a lot of fun. It's been something that we tried again, unusually different. We've got our friend Stuart Shadi from Standard Bank sitting in the Standard Bank building, and then you have Stuart and Justin in the Biznews offices in Johannesburg, and of course I'm in the Biznews office in London. So it just shows the miracles of modern technology. We'll be back again in a month's time with another update. Just to leave you with the portfolio generally, though, it has been an extraordinary month for us. Oh, there's the dividend receipts. My goodness. My apologies. I went through this a little bit quickly. But if you have a look, one of the questions was on the dividend receipts. There you'll see Vanguard, since we started, has actually declared 6 dividends. That's in the last 17 months. And those dividends are around about $1 each time. Apple also a good dividend payer as well. So I just leave you with the overall figure that the portfolio annualized is now up 36%. That's in the last 17 months. Long may it continue. Look forward to being in your company again, same time next month.